Welcome to the DX Today podcast, where you get facts and no hype. Today, we are strapping in for a deep dive that sits right at the critical intersection of Silicon Valley ambition and Wall Street liability.
That's a great way to put it.
We're talking about what has really become the new frontier of corporate risk. This massive surge in legal action targeting companies that promise AI capabilities they simply cannot deliver.
Right. And this isn't just about general hype anymore.
No. This is about specific, quantifiable metrics that are now landing executives in court.
It's an environment that has changed fundamentally, I'd say, in just the last 18 months or so.
It feels that fast.
It is. What our sources are revealing is a complete and, I think, irreversible shift in the legal landscape. For decades, claims about innovation or proprietary algorithms.
Sure, that was standard marketing.
It was. It could often be dismissed as immaterial puffery, vague marketing fluff that no reasonable investor would rely on solely.
But not anymore.
Not anymore. Now, the stakes are concrete, and the strategy of the plaintiffs, the shareholders who feel burned, has sharpened dramatically. We are witnessing the birth of a major new legal risk category.
Okay, let's unpack this and really define the territory for everyone. We're dealing with what the sources are calling AI Performance Securities Litigation. And it seems so perilous because it bypasses all the philosophical arguments about what AI is or could be, and it goes straight to the bottom line.
Yes, exactly. It's no longer about general excitement.
It's about very specific, measurable performance metrics that they fail to materialize when the business model is actually stress tested in the real world.
That is the core legal pivot. Plaintiffs are specifically targeting corporate claims around really 4 key areas.
Okay, what are they?
First, the speed of the AI process.
Okay.
Second, the accuracy of its predictions. Third, the level of autonomy in its decision-making. And critically, fourth, the resulting revenue generation that's attributed specifically to that AI.
So if you put a number on it?
If you put a number on it. If you claim your AI reduces operational risk by 40%, or it accelerates development time by 30%, and then your stock collapses when external conditions shift,
that number comes back to haunt you.
It becomes the direct evidence, the smoking gun, used in a securities fraud lawsuit under Section 10B.
And the data point that's driving this entire deep dive is, frankly, staggering. It just shows the velocity of this shift.
It really does.
The research we reviewed notes that in 2024, AI-related securities class action lawsuits more than doubled compared to the previous year.
Doubled. In 1 year.
That suggests the entire environment, legal, regulatory, private litigation, it's all changed almost overnight. It's moved from, a mild concern to an active minefield.
I think that's the perfect term for it. It's an exponential growth in liability risk for any company whose valuation relies heavily on a claimed AI capability.
So our mission today is really to show you, the listener, exactly how these decades-old securities fraud statutes—
We're talking Section 10B and Rule 10b-5, which have been around forever.
Right. How are they being applied with really devastating effect to cutting-edge technologies like deep learning, neural networks, and generative AI?
We need to understand the precise legal mechanism of accountability here, because the SEC has already moved way past the warning phase.
They're in enforcement mode now.
They're in aggressive enforcement mode, and that's what set the definitive precedents for this private litigation wave we are now seeing wash over the entire market.
That transition from just mild guidance to actual regulatory punishment, that's where we need to start. It's what paved the way for all of these private lawsuits.
Absolutely.
So let's dig into that, the AI washing crackdown.
What's fascinating here is just how quickly the regulatory climate crystallized around this concept of AI washing.
A term we hear everywhere now.
It's everywhere, and it's heavily emphasized by SEC Chair Gary Gensler. It really defines the practice of exaggerating, misleading, or just outright fabricating artificial intelligence capabilities to attract investment and then inflate corporate valuations.
It's a direct response to the market frenzy, right? I mean, you add AI power to a press release, and your market cap can jump by billions.
Instantly. So if those technical capabilities are presented as a material factor, the very reason for that investment premium, but those capabilities don't actually exist.
It's not just bad marketing.
It's not. It crosses the threshold directly into securities fraud. And our sources detail a very distinct 3-phase timeline for the SEC's strategy here.
Okay, let's walk through that. What was phase 1?
Phase 1 was the warning phase. This was largely preventative, aimed primarily at investment advisors.
Just putting them on notice.
Exactly. The SEC issued guidance emphasizing that they must be entirely truthful about their AI representations In marketing materials and client communications, this was the agency planting its flag,
Yeah.
you know?
Signaling that these claims would be scrutinized.
Right. Just like any other claim about a firm's investment methodology or its personnel, it was a clear initial message. Treat your AI claims with the same rigor you would your historical financial data.
And then the warning stopped and the enforcement started.
In earnest. That brings us to phase 2, enforcement actions. This was the first wave of actual fines levied against firms, and you have to understand, these cases are the bedrock for the current private litigation surge.
So who are they targeting in this first push?
The key targets were investment advisors, specifically the ones who claim to be utilizing sophisticated proprietary AI algorithms for portfolio management and optimization.
The classic quant fund pitch, but with an AI label.
Precisely. And the SEC investigations, well, they quickly revealed the reality was far less sophisticated. In many instances, these firms were just using basic, decades-old statistical models.
Make what?
Maybe some multiple linear regression or simple time series analysis, things you'd learn in a first-year stats course. They just relabeled it AI-powered or deep learning.
That's pretty blatant.
It gets worse. There were even more egregious examples of firms relying on manual human analysis, portfolio managers making subjective calls, while publicly claiming those decisions were fully automated by neural nets.
Wow. So they were penalized not for the AI performing poorly,
but for flat-out fabricating the utilization of AI in the first place,
Okay.
all to attract clients and, of course, charge those premium fees.
So the SEC established a really clear principle here. You don't even have to prove the AI failed. You just have to prove the company lied about having it or lied about its level of sophistication.
Precisely. That's where the precedent was set.
Mm.
The core message from these early cases is just crucial for any sophisticated investor tracking this issue.
Which is?
Technological complexity is absolutely no defense for misrepresentation. If AI capabilities are presented as a material factor in your business model, the reason analysts are buying your stock at a premium, then those capabilities must be substantiated with the robust technical and operational evidence.
You can't have it both ways.
You cannot. You can't market a black box based on its amazing performance and then hide behind the complexity of that same box when you face scrutiny.
And that, of course, gave way to the current climate. Phase 3, the litigation surge.
Right. Once the SEC defines AI washing and proves it's legally viable by successfully levying fines, the private class actions quickly follow.
They just piggyback on the government's work.
Of course. The plaintiff's bar recognizes that the hard work of defining the fraud and gathering that initial evidence has already been done by the government. It's a very predictable and now a very accelerated cycle in securities litigation.
To give this some grounding, it feels like there are parallels here to past tech bubbles.
There are. We have to acknowledge the historical context.
Yeah.
When you look at the rapid commercialization and the legal fallout, the parallels to the 1998 to 2005 .com era are striking, but there's also a critical difference.
Oh, I remember that era vividly. Companies would just add .com to their name or announce an internet strategy.
And the stock would spike wildly, right?
Mhm.
Regardless of actual business fundamentals or any monetization strategy. It was pure speculation based on perceived future access to the internet, not unproven capability.
So that's the similarity. Both eras involve a truly transformative technology, speculative bubbles, and just rampant overstating of capabilities.
The classic pump and dump cycle,
Yeah.
just dressed up in new technological language. We saw a massive litigation wave back then, too, targeting companies for overstating internet capabilities, website traffic, unsustainable revenue projections. Those cases also set precedents for technology-based fraud claims.
But AI introduces a layer of fundamental complexity that the .com era, for all its madness, didn't really have to contend with.
It does, and that complexity is the black box problem. The internet was relatively transparent. A website either loaded quickly or it didn't. The underlying infrastructure was, understandable.
All right.
AI, however, is inherently opaque. Even its creators, the highly skilled data scientists and engineers, sometimes struggle to explain why a model made a specific high-stakes decision or why it failed catastrophically in some edge case.
That opacity, it seems like it cuts both ways.
It absolutely does.
Okay.
On one hand, the black box nature creates a perfect opportunity for fraudsters to misrepresent capabilities, knowing the technical details are inaccessible to general investors.
But on the other hand,
On the other hand,
Right.
it creates a massive challenge for litigators who are trying to prove fraudulent intent, or scienter as the lawyers call it. The defense often tries to hide behind that very complexity, claiming the failure was just an inherent R&D risk, not a deliberate lie.
So the legal system is now struggling to define that line between an honest, complex, technical failure and reckless corporate misrepresentation.
That is the new battleground.
Okay, so the SEC and the private plaintiffs, they're now forced to pierce that complexity. And our sources detail that they are successfully finding evidence in two pretty insidious categories of misrepresentation. Let's start with the one that feels, I don't know, most like classic financial fraud just dressed up in new clothes.
That would be the Wizard of Oz risk. This first category deals with operational fraud that's masquerading as technological innovation. And it's arguably the easiest one for plaintiffs to prove because it attacks the financial basis of the company's valuation directly.
The name is perfect, the man behind the curtain.
The deception is chillingly straightforward. Companies promise investors that their product operates using fully automated, scalable AI. But in reality,
There are people back there pulling livers.
exactly. They substitute human labor, often large, hidden teams of contractors or offshore workers, to perform the tasks the AI was supposed to handle. The humans are essentially fixing, cleaning, or just generating the output manually. It completely misleads investors about operating margins, scalability, and the company's true cost structure.
The financial impact there must be profound because the entire value proposition for a software company hinges on scalability.
It does.
Investors are pricing the company based on this assumption of near zero marginal cost for software operations, that exponential leverage that AI supposedly provides.
Exactly. And when the hidden human labor is revealed, the entire valuation just collapses. Software scales beautifully, but a hidden army of low-wage or contract workers?
Not so much.
Not at the same cost. The revelation that your margins depend on an unscalable hidden cost structure, it fundamentally changes the valuation equation from a high-flying tech multiple to a low-margin services multiple.
And that immediately triggers massive stock corrections and, of course, the securities litigation we're seeing.
Inevitably.
The data our sources have compiled on the severity of this is shocking. In the cases that have been exposed, the dependency rate on human intervention for these AI outputs was a staggering 78%.
78%. That's a system where the AI is, at best, a co-pilot, and at worst, a total fiction.
It's almost total dependency disguised as autonomy.
It is, and the scale of the financial damage is equally clear. The average market cap decline when these Wizard of Oz schemes are revealed is $3.2 billion.
$3.2 billion.
That statistic alone should be required reading for every corporate board. We're not talking about a rounding error. This is an existential threat. And what's more, the data confirms there are currently 24 active securities lawsuits alleging this exact pattern of human substitution for promised AI automation.
So courts are not buying the complexity excuse for this one.
They are proving to be extremely unsympathetic to defendants trying to use technological complexity as an excuse for this kind of fundamental operational misrepresentation.
Okay, that covers the operational side. Now let's pivot to the second category, which feels more purely technical and maybe more insidious because it targets the inherent fragility of machine learning systems.
Right. This is model drift as securities fraud.
Model drift.
This represents a major legal evolution. It takes what was traditionally seen as just an unavoidable technical maintenance issue, and it redefines it as a potential legal liability.
So define model drift for us.
Simply put, it's the deterioration of an AI model's predictive accuracy over time. It happens because the real world conditions the model encounters in production. They inevitably diverge from the original data it was trained on.
It's like the AI equivalent of driving with a map that's 10 years old. Eventually, the roads change, new buildings go up, and the map becomes useless.
That's a perfect analogy, but the question is, how does that technical challenge become a legal violation?
Right.
It crosses the line into securities fraud when the company's disclosures about the model's reliability are misleading. If companies overstate the model's adaptability, if they market it as future-proof or crisis-tested, or crucially, if they fail to disclose the inherent risks of drift and the lack of robust monitoring systems.
That failure to disclose becomes a material misrepresentation.
Under Section 10b, yes.
So the generic boilerplate risk language that you see in every filing, the kind that says algorithm performance may vary depending on market conditions, that's no longer sufficient protection. Absolutely not. The emerging legal standard demands specific technical disclosures. The new expectation is that companies must detail several critical maintenance elements.
Like what specifically?
They must disclose first what monitoring systems they have in place to detect drift. Not just that they monitor, but how they monitor and how often.
Okay.
Second, how frequently the models are retrained to account for new data. This includes the latency, the time between detecting the drift and actually deploying a fix. And third, what specific quantitative performance degradation triggers intervention by a human team.
Wow.
If you're claiming superior risk management or predictive capability, you have to disclose the operational reality of maintaining those models, including their limitations in a rapidly changing environment.
This shift is demanding an unprecedented level of integration between the data scientists and the legal counsel. The engineer's internal dashboard is now potential evidence in a securities lawsuit.
It absolutely is.
So to really understand how this all works, maybe we should quickly review the fundamental legal machinery.
We should. We're relying on Section 10B of the Securities Exchange Act of 1934. It's this broad, powerful statute that prohibits any manipulative or deceptive device in connection with the purchase or sale of securities.
And then there's Rule 10b-5, which is really the engine of private litigation.
Exactly. Rule 10b-5 creates the private right of action, which allows investors to sue for damages after a stock price tanks due to a revealed fraud.
And our sources detail a very predictable 6-step progression that nearly every successful AI securities fraud claim seems to follow.
It's a clear pattern, moving from a corporate claim to the courthouse.
Let's walk through that sequence. What's step 1?
Step 1 is the material misrepresentation. This is where the company makes those specific quantified claims about AI performance, its capabilities, or business impact in public statements, earnings calls, SEC filings.
For instance, claiming, our AI can predict market swings with 95% accuracy.
A perfect example. Step 2 is reliance by investors. The market then prices the securities based on these AI claims. You'll see institutional investors, analysts, market commentators all citing these capabilities as the source of the company's high valuation premium.
Step 3, of course, is the performance failure. The AI system fails to deliver on those specific promised results.
And this is often due to technical limitations, like the model drift we just discussed, or in the worst-case scenario, it was simply fabricated to begin with.
And this failure often aligns with some significant adverse market event, like a crisis or a big macro shift.
Correct. Step 4 is the disclosure of reality. The bad performance or the underlying deception, like the Wizard of Oz scheme, it becomes public.
How does that usually happen?
Typically through whistleblowers, internal leaks, investigative reporting, or sometimes forced admissions in subsequent company filings that are required after the performance collapses.
Then comes step 5, the swift and painful stock price correction. The market instantly revalues the company based on the actual versus the claimed AI capabilities.
Which results in massive, measurable shareholder losses. And finally, you get step 6, the inevitable securities litigation. The class action is filed under Section 10B and Rule 10b-5, alleging that the initial security purchases were all predicated on a lie.
In this framework, I'm really struck by the materiality element. In the past, proving a statement was important enough to actually sway an investor. That was often a major hurdle. Why is that element getting so much easier to prove in these AI cases?
It's easier because the valuation premium is transparent, and it's immense. Companies aren't just trading on some vague future potential. They're trading at multiples specifically attributed to their perceived AI capabilities. The market calls it the AI multiple.
Right.
So when a company's stock triples because it claims a revolutionary AI-powered trading edge, that claim is inherently material to any reasonable investor's decision. If the underlying capability is false, the entire premium is considered fraudulent.
Because the investor paid for something they did not receive.
Exactly. The market itself has assigned a material financial value to the claim.
Okay, that brings us to what's always the hardest part of any fraud case. Scienter. Proving intent. Plaintiffs have to prove the defendants either knew the claims were false or they were reckless in not knowing the claims were false. When you're dealing with these highly complex, cutting-edge machine learning models, how on earth do you prove that knowledge or recklessness?
This is where the discovery process becomes the legal equivalent of an archaeological dig into a company's internal communications.
They're looking for emails, Slack messages.
Everything. Plaintiffs are actively hunting for internal documents that prove a disconnect between the technical reality and the public claims. We're talking about damaging evidence specifically, internal emails, Slack messages, or chats showing that engineers or data scientists raised concerns.
So they warned them.
They warned them explicitly about limitations, suggested more conservative marketing language, and yet those warnings were consciously overridden or ignored by the executives making the public pronouncements.
So that executive overrule of technical advice, when it's documented, that's the clearest path to proving scienter.
It is. It suggests the executive had knowledge of the risk, or was at least reckless in ignoring it while actively pushing a false narrative to inflate the stock price. The documentation of that internal debate is everything.
Can you give an example?
Sure. An email from a lead data scientist saying, our internal validation shows 65% accuracy under stress, not the 95% marketing wants to claim. And that's followed by a public press release claiming 95% accuracy. Well, that is highly damning.
And the defense's argument would be what?
The defense counterpoint will, of course, be that the inherent uncertainty and the rapid development cycles in AI, the projections were merely optimistic, made in good faith. That performance failures are a normal, accepted challenge of deploying cutting-edge technology.
They'll argue against recklessness by claiming it was just unavoidable technical difficulty.
Right. But our sources indicate that courts are growing increasingly skeptical of this inherent R&D uncertainty defense.
Why is that?
They are, particularly when specific quantified claims were made. Once you put a hard number on it, this system achieves X performance. The defense of inherent uncertainty starts to ring pretty hollow.
Especially if there's no documentation to back it up.
Exactly. Especially if those claims weren't backed by adequate, documented testing and validation. Furthermore, the court expects executives to establish sufficient internal controls. If the CEO never even asked the head of engineering for validation metrics before going public, that lack of oversight can itself be deemed reckless.
So the complexity of the tech no longer excuses a lack of support for specific promises.
It actually demands greater technical diligence.
Okay, let's move from the theoretical legal framework to some tangible reality. Let's examine two specific case studies that exemplify these new liability categories.
Good idea.
This shows exactly how the technical and legal worlds collide. We can start with the classic example. The collapse of a fintech algorithmic trading company.
Yes, this case became a textbook example. It was model drift coupled with documented, overruled expert warnings. It was a perfect storm for a securities lawsuit.
And the company's claims were really attractive, right?
Oh, highly attractive to institutional investors. They promised superior, non-correlated, risk-adjusted returns from their proprietary algorithms. And they heavily marketed that these systems had been rigorously stress-tested against every major market crisis, explicitly citing the 2008 collapse as a scenario their models could navigate safely.
And the market believed them. Investors poured capital in, the stock price tripled, all due to this touted AI-powered trading edge. It was the ultimate promise, stability, coupled with outperformance.
But the failure arrived not during a classic financial crisis, or during a rapid macro shift in early 2023.
What happened?
It was a combination of unexpected rapid interest rate increases and heightened geopolitical tension. This pushed market volatility and correlation dynamics far outside the historical norms that were contained in the model's training data.
And instead of protecting capital,
it failed catastrophically. The algorithms actually amplified losses through leveraged positions. They were optimized for efficiency in a stable market, not for survival in a turbulent one.
So why did the failure mode shift like that, from mitigating risk to amplifying loss? What did the investigation find?
The investigation revealed two critical failures. First, the models had been heavily optimized for the low interest rate, quantitative easing market regime of the prior decade. They were fundamentally brittle. They lacked robust adaptation mechanisms for a sudden inflationary environment.
And the second failure?
The second was that the sophisticated stress testing they had publicly claimed relied only on static historical data. It failed to account for massive structural shifts in market microstructure, like the reduced liquidity and high-frequency trading dominance that defined the 2023 environment. It rendered their crisis testing totally irrelevant to the present.
And this is where the scienter element, the intent, became undeniable. The fraud wasn't that the model failed, it's that the company lied about how robust it was.
Precisely. The subsequent class action discovery unearthed those smoking gun internal emails.
The ones we talked about.
The very same. They showed data scientists had repeatedly warned management about the algorithm's inherent brittleness, specifically citing the risk of leveraged positions in a sudden rate hike environment. They recommended making more conservative marketing claims.
But they were overruled.
Senior executives explicitly overruled these suggestions. They viewed aggressive, quantified AI claims as absolutely essential to maintaining the company's crucial valuation premium.
And that gap between the engineer's caution and the executive's public ambition, that caused a catastrophic loss of investor confidence.
The stock collapsed 78% in less than a week. The company ended up settling the lawsuit for a huge sum $340 million, and it established that specific disclosure is now required for testing methodologies and performance limitations.
So it set a precedent.
A huge one. The settlement signaled clearly that generic claims about stress testing are now subject to technical scrutiny in court. The legal system established that if you promise a specific safety feature, the technical validation of that feature is a material fact.
Okay, now let's turn to case study B, the one involving real estate valuation AI failures. This seems like a perfect illustration of that temporal degradation aspect of model drift.
It is. This involved companies in the proptech sector.
Right.
So technology focused on property and real estate that had promoted AI models for property valuations.
And their public claims were pretty bold.
Very bold. Boasted accuracy rates as high as 95% across all market conditions. They positioned themselves as vastly superior and faster than traditional human appraisal methods, and they successfully attracted massive investment capital based on this promise of consistent, automated precision.
And initially it worked, didn't it? During the stable period of low interest rates, say between 2019 and 2021, when property values were just appreciating consistently.
They did. The models performed adequately within their training parameters. But the market was on the cusp of a systemic shift that their historical data just could not predict.
The pandemic.
Right. The convergence of two massive factors. The post-pandemic surge in remote work, which completely changed the geographic desirability of housing, and the rapid rise of interest rates, which altered the financial calculus.
So the AI models were trained primarily on pre-pandemic data sets.
Exactly. Assuming certain commute patterns, assuming stable financial leverage costs, their training data had a huge temporal degradation problem. The models were fundamentally blind to the new market dynamics.
So what was the result?
They systematically overvalued property types that relied heavily on pre-pandemic urban models, like commercial urban cores, and they undervalued suburban or rural areas that were suddenly seeing this massive remote work-driven demand.
They were accurately valuing the real estate market of 2019, not the volatile, structurally changed market of 2023.
That's it exactly. And investors who purchased large portfolios based on these flawed automated valuations suffered massive overcapitalization and significant losses when the true market value was revealed.
And the litigation hook here, again, wasn't that real estate is complicated.
No.
It's that the companies overstated the AI's adaptability to exactly these types of large-scale market shifts.
Yes. The plaintiffs argued the companies failed to adequately disclose the model's heavy reliance on outdated market assumptions and the inherent inability of the model to incorporate new qualitative macro factors like remote work suitability that were just absent from the historical training data.
So these case studies really underscore a core legal reality.
Right.
The technical limitations of AI drift, brittle data, testing inadequacy, they're no longer just R&D hurdles.
They are now material legal liabilities that must be disclosed and managed proactively.
So we've identified this strategic paradox for companies in this hyper-competitive AI landscape. To win investment and satisfy analysts, they have to be specific about their performance. But our sources are unanimous that specificity is the single biggest litigation trigger.
It is the defining risk factor. Statements that are vague, like our AI improves customer experience, carry minimal legal risk. They're hard to disprove materially.
Right.
But specific quantified statements like our AI reduces operational costs by 40% or our model achieves a 99% reduction in false positives, those carry an existential risk.
Because that specificity creates an objective, measurable falsity if the claim proves inaccurate.
Exactly. And the numbers back this up dramatically. It turns a general observation into an enforceable legal pattern. The data shows that 87% of AI securities cases involve quantified performance claims.
87%.
And even more startling, the average settlement multiple for cases relying on those quantified claims is 3.8x higher than settlements for cases that rely on just general statements or soft projections.
So the plaintiff attorneys know exactly where the money is.
They actively weaponize these concrete metrics found in earnings, called transcripts, investor presentations, and product specifications.
So companies are caught in this brutal strategic bind. Competitive dynamics push them toward precision, but precision creates undeniable legal exposure when performance fails. It's a transparency versus liability tightrope walk.
And that leads directly to the next major liability area, which is highly technical, the data provenance problem.
Data provenance.
When a company claims superior AI performance, the data used to train that model becomes material information about the quality and efficacy of the product itself.
The analogy our sources use here is really powerful, they say. Data is to AI what ingredients are to pharmaceuticals.
That's a perfect analogy.
It's material to the quality and efficacy of the final output. If the ingredients are contaminated or substituted, the product fails, and the claims about the product are fraudulent.
That analogy holds up perfectly in court. Just as a drug company has to disclose its manufacturing process and clinical trial data, AI companies are increasingly expected to provide sufficient information about their data sources, so sophisticated investors can assess the credibility of their performance claims.
If the underlying data is garbage, the performance claim is garbage.
It's equally dubious, yes.
So what are the three core data liabilities that plaintiffs are exploiting in these lawsuits?
First, you have data source misrepresentation. This is when companies claim to have unique, proprietary, or high-quality gold standard data sets.
But in reality?
In reality, it's just thinly processed data scraped from publicly available sources, low-quality purchase data, or data contaminated with systematic errors. They're selling an exclusivity that just doesn't exist.
Okay, what's the second?
Second is bias and representativeness. This is the failure to ensure the training data accurately reflects the real-world operating environment. If the training data systematically excludes important populations or adverse scenarios or key market regimes.
Like the pre-pandemic real estate data.
Exactly. It leads to predictable failures that should have been foreseeable and disclosed as a limitation. If the model fails because it only works for a subset of the target market, then the claim of general utility is fraudulent.
And the third?
Third is temporal degradation. This is simply relying on historical data that becomes fundamentally outdated without adequate retraining protocols or acknowledging the model's declining utility over time. All three of these issues, when they lead to model failures and stock collapses, are now being successfully litigated as securities fraud.
Because the company failed to disclose these material limitations about the source and quality of the AI's ingredients.
That's right.
Given all this complexity, what about the classic defense we hear touted in the tech world? The black box defense. Can't defendants just argue that AI is inherently too complex, too opaque, and so any performance failures were just good faith miscalculations, not fraud?
That defense is rapidly losing all legal traction. Courts are highly skeptical of it. The legal reasoning is pretty damning. If the system is truly so opaque that you cannot explain its decisions, audit its methodology, or confirm its testing, then making concrete, quantified performance claims about it in the first place is considered reckless conduct.
And reckless conduct is enough.
Under Section 10b, it satisfies the scienter requirement.
So admitting the system is a total black box actually undermines their own claims of adequate testing and validation. It basically proves the recklessness element for the plaintiffs. It's a perfect legal trap.
It is. More sophisticated defendants, they'll try to argue a middle ground. They'll acknowledge inherent uncertainty while trying to demonstrate robust audible testing and validation protocols.
But that only works if it's true.
It only succeeds if it's backed by documentary evidence of actual testing protocols, statistical validation, and reasonable performance boundaries that were honestly disclosed to the public. The overall takeaway is critical. Complexity does not excuse misrepresentation. In this environment, it drastically increases the disclosure burden.
And what about the protection offered by that decades-old legal shield, the forward-looking statement safe harbor? The Private Securities Litigation Reform Act was designed specifically to protect companies making projections about the future. Does it offer any sanctuary here?
It offers limited, and I'd say often misleading, protection in the AI context. The PSLRA safe harbor protects projections and forecasts if they're clearly identified as such and are accompanied by meaningful cautionary language.
But it's failing AI companies.
It's failing them in two critical ways.
Let's detail those limitations, because this seems like a mistake a lot of general counsel departments could be making right now.
First, statements about current capabilities, such as, our system currently achieves 90% accuracy in production. Those are deemed statements of present fact, not forward-looking projections.
So they get no safe harbor protection.
None whatsoever. If that current fact is false, it's fraud. Second, and this is the most significant part, the safe harbor is voided entirely if the projection is based on a false statement of current fact.
Can you explain that?
Sure. If you project future performance, say, we expect to achieve 95% market penetration due to our superior AI, but that projection is built on a fraudulent claim about your current capabilities.
Like claiming you achieved 98% accuracy in testing when the log files show it was really 50%?
Exactly. Then the entire statement loses its protection.
So if the foundation of current fact is rotten, the aspirational language about the future does nothing to protect you.
Nothing. The safe harbor encourages honest disclosure of uncertainty, but it cannot be used to cover up a lie about the present reality. And furthermore, the bar for what constitutes meaningful cautionary language is rising. Generic warnings about business risk are not sufficient anymore.
The warning has to be specific.
It needs to address the specific quantifiable risks of AI performance failure like potential model drift given specific market conditions or reliance on proprietary but fragile data sets.
So, given this environment, what does this mean for companies trying to survive this legal surge? They need a definitive roadmap for transparency and governance that goes way beyond traditional compliance.
They do. And the sources outline a necessary strategy that moves companies past those boilerplate generic risk factors toward highly detailed technical documentation. It's often referred to as the technical appendix approach to disclosure.
A technical appendix.
It's becoming standard practice for sophisticated companies that are aiming for those high AI multiples.
This sounds less like legal documentation and more like a detailed technical white paper for sophisticated institutional investors.
That's a good way to think about it.
What are the key areas that need to be documented and disclosed in this approach?
There are 6. 1, system architecture. Describe at a high level the model types, the training approaches, and how the AI integrates into key business operations in a way sophisticated investors can grasp. You're trying to demystify the black box a little bit.
Okay, what's 2?
2, performance metrics. Report actual, externally verifiable testing results. This includes confidence intervals, the specific conditions you tested, and critically, the limitations of that test environment compared to real-world production. You have to disclose the worst-case scenario alongside the best.
Number 3.
3, data dependencies. Detail your data sources, the quality assurance processes used to clean the data, any representativeness limitations. For example, model trained only on U.S. market data from 2010, 2020, and the refresh cycles for your training data. This directly addresses the provenance problem.
4 is monitoring and adaptation. Explain the systems you have in place to detect model drift, the methodologies used to measure degradation, and the specific performance thresholds or triggers that initiate human intervention or automatic retraining.
5, risk factors. Identify specific, non-generic scenarios, unique market conditions, data unavailability issues, known algorithmic edge cases, where AI performance is explicitly expected or documented to degrade. This avoids overstating adaptability.
And finally, number 6.
And 6, human oversight. Describe the exact extent of human involvement in generating outputs, the review processes, the frequency of human override, and the capabilities humans have to intercede when the AI system falters. This proactively tackles that Wizard of Oz risk by defining the role of the human element.
That is comprehensive, and it demands technical expertise at the highest level of corporate oversight. This isn't just a compliance challenge, it's a fundamental governance challenge. The board and audit committees need AI-specific frameworks.
They do, not just general operational risk frameworks. Boards need to establish specialized AI governance committees that mandate technical expertise, maybe by appointing a director with a deep technical background.
And what would those committees do?
These committees must require regular documented reports comparing actual audited AI performance against all public claims. They should also implement internal red team exercises where technical experts are tasked with finding the gaps between claims and actual capabilities, and they report directly to the board.
And crucially, directors themselves face personal liability here under oversight failure claims, don't they?
Absolutely. Directors are being put on notice of this new critical risk area. They must document their AI oversight activities meticulously through detailed board minutes. They need to require third-party technical audits of AI claims, ensuring they ask specific, informed questions about testing and validation.
Because failure to ask is a problem.
The documented failure to ask basic, informed questions about the technical foundation of a company's core asset that can be interpreted as an oversight failure and potentially lead to claims of bad faith.
The core cultural conflict we identified earlier, the naturally cautious engineer versus the aggressive marketing team, that needs to be solved structurally to prevent this kind of fraud.
This is the pre-disclosure review process, and it demands a cultural sea change. The tension is immense. Technical teams focus on limitations, confidence intervals, failure modes. Marketing teams want bold, differentiating narratives. Securities law demands accuracy and defensibility above all else.
So the C-suite has to arbitrate this.
Decisively. The mitigation strategy here is to structurally empower the technical staff.
How do you do that?
Effective review processes must implement technical review gates. Data scientists and engineers have to be given the explicit, institutionalized power to veto or substantially modify claims they cannot empirically support.
Even if that veto disappoints senior business leaders or delays a press release.
Especially then. This elevates technical accuracy to a core corporate value. It ensures that public claims are stress-tested by the people who actually built the system before they ever reached the market.
Finally, let's look ahead. What is the emerging standard of proof and transparency that might reduce this litigation risk entirely? What could make a company virtually bulletproof against these claims?
We are seeing the emerging proactive trend of algorithmic auditing.
Algorithmic auditing.
It's conceptually analogous to a financial statement audit, but it's applied to the AI system itself. It's a comprehensive, independent third-party verification of the model, the data, and the performance claims.
So, bringing in a specialist firm to verify the integrity and claims of the algorithms before they are relied upon by investors.
Exactly. Industry groups and audit firms are rapidly developing systematic methodologies for testing, documenting, and validating these performance claims. Companies that voluntarily adopt these standards demonstrate a profound commitment to transparency.
And critically, they create powerful, objective defensive evidence if litigation arises later.
Right. This external verification helps shield the company from claims of recklessness. These algorithmic audits typically involve reviewing comprehensive testing protocols, statistical validation of quantified claims, evaluation of training data quality, and a detailed assessment of the monitoring systems for model drift.
It turns subjective claims into objective, auditable facts.
It does. And while these audits add significant costs, they appear to be the single most effective way to reduce litigation risk, enhance genuine investor confidence, and catch major performance issues, like the systemic failures we saw in the case studies, before they cause a multi-billion-dollar stock collapse.
It's moving AI development from a secretive, artisanal process to a standardized, verifiable, and regulated discipline.
It has to. The new legal environment demands a fundamental change in corporate operations. General counsel must inventory every public AI claim, implement those technical review gates, document everything, every test, every validation study, every dissenting email, and train communications teams on the legal implications of technical exaggeration.
The culture of absolute accuracy has to permeate the entire organization.
From the data lab to the earnings call stage.
So, to summarize the central finding of this incredibly detailed deep dive, the era of treating AI as vague marketing hype is definitively over.
It is.
The legal system, led by the SEC and private plaintiffs, is rapidly establishing standards that demand technical accuracy, rigorous testing, and honesty about both capabilities and, crucially, limitations.
And transparency is no longer a soft public relations strategy. It is the primary strategy for managing existential legal risk. Companies can no longer hide behind the complexity of the machine. The sophistication of the technology increases rather than decreases the disclosure burden.
Success in this new climate really requires total technical legal integration.
It's the only way.
You know, what stands out to me is that the decision to be specific about performance creates this clear legal exposure, but in a capital market that's hungry for differentiation and genuine insight, those who are aggressively transparent might actually gain a competitive edge. They might attract serious long-term investors.
And this leads us directly to our final provocative thought for you to consider.
Mm-hmm.
We've clearly established that specificity creates liability, but that it is also what creates genuine investor confidence and commands a high valuation.
The ultimate catch-22.
It is. So as AI becomes more fundamental to business valuation, will companies that refuse to disclose the technical details of their algorithms, trying to hide behind complexity, will they eventually be unable to compete with those who embrace deep, auditable transparency? The question is no longer whether complexity shields liability, but rather whether a continued insistence on opacity ultimately dictates commercial failure.